Good morning, traders. I just got done completing the custom index video. Please take a look at it. It's a bit long, but it goes over so much detail regarding what's actually taking place in the markets and what to expect 3, 4, 5+ weeks into the future. This video on December 17th, Saturday, early in the morning, is the MENT Rotational Modeling System and RealEstate video. This is where we talk about the status of the MENT Rotational Modeling System as we move into the end of the year and what we should be doing overall to protect and manage our allocation. Remember, the process for me and all of you, if you're following my research, is the MENT Rotational Modeling System allocates the basis of our equity allocation. From there, we go to the custom index charts to see what's taking place in the markets, get a better feel for what's actually taking place in various sectors and trends and components of the market. And as well, we then move into the TT scanner hot lists and the live trades daily algos for trading opportunities. Right now, nothing has changed this week. The S&P rotational modeling system is still bullish. So we are bullish on the weekly basis with 25% allocation. And on daily, we are bearish with 75% allocation. So if you had two accounts, these would be the way you would have set them up. 25% of your capital would be bullish from 6/10/2020 from a price of 319. Current price is 383. We're up 20% in this position. And 75% in a separate account would be bearish. From 8/31/22, we are up 4.17% in this position. If you consolidate them into one position, you would be combined position, 50% bearish, 50% cash. You would have taken a short position on 8/31/22, and you would be up 4.717% on that position in a consolidated one account basis. I am executing in the two account basis. It basically works that this 25% bullish offsets 25% of this position in a scenario that gives us a 1-to-1 ratio. So when we're mixed like this, where daily is bearish and weekly is bullish, this 25% is essentially flat. Okay, it's offset because this is whatever. If it goes up $1 here, it goes down $1 here. Okay. Now the trending models for this week, the only thing that has really changed is that crude oil went into a bearish trend on a weekly basis, and this could continue to unwind for quite a while. Consumer staples are still positive. Dow Jones is still positive daily and weekly. SPY is bearish daily, bullish weekly. Let me come in here. Trans are bearish, both daily, weekly. Mid cap is bullish, both daily and weekly, which is showing us that mid cap and small cap, as well as consumer staples and the Dow Jones, have moved considerably higher. So we're seeing some sort of a recovery here in essentially large caps, small caps, mid caps, and consumer staples. But overall, we are still bearish with the transportation index, indicating the economy is not expanding. S&P 500 is mixed. NASDAQ is still bearish. Gold and silver are bullish on the daily, bearish on the weekly. And crude oil appears to be contracting downward, which again, a contracting economy would essentially prompt downward bearish activity. With regards to our allocation levels, this is the primary basis for how you should be looking at the high-level overview of your trading account going forward. You are allowed roughly, with my modeling system, I don't want to say it the wrong way, but with the rotational modeling system, you should be allowed 10 to 20% into stocks, 55 to 65% in cash, metals at about 25%, and bonds at 0 with the primary allocation level. In the alternate allocation level, you would be 10 to 20% stocks, 80 to 90% cash, and 0% into bonds. The reason being is that we base everything off of the primary system, the S&P and the transportation index. So even though we're seeing some bullish activity elsewhere, we are not seeing anything to allow us to jump in and become aggressive at this point in the markets. I increased this to 20% last week because I wanted to be able to set up and prepare you for a potential reflation trade going into 2023. But again, we are still safely hedged with most of our money sitting in a cash account, a secondary amount into a hedged metals position, and we're trading with a very small position here. So understand that if we were trading and we were to take hypothetically a 3% loss on some stock, whatever it is, and it might be out of that the stock allocation, say 20%, we broke it into 10 slots for our stocks. That would be, each stock would be about 2% of our capital allocation. That would mean that a 3% loss on a stock, on any individual stock, would actually reflect out as a 0.6% loss on our portfolio. It would be a very small amount, which is why we are trading these very small position sizes. You can still trade, but if the market moves against you, or you take a loss, say you took a 2.5 or 7% loss, okay, that would end up being a 0.7% loss or a 1.4% loss if you had allocated it effectively using this 20% allocation level in 10 open trading slots. So hypothetically, each stock would be trading 2% of your allocation. That means that of your total allocation, that means that a 7% loss ends up being a 1.4% loss overall on that potential stock. So it gives you the ability to trade without risking too much and staying effectively hedged and protected. Now, the rotational modeling system, as of end of November, was doing quite well. In fact, as of the end of November, we had almost turned into a positive. Now, with the markets down a little bit, this is probably going to be back around minus 1.6, maybe 1.8, somewhere around that area. We'll see how it plays out near the end of the year. But overall, the MENT Rotational Modeling System is doing quite well compared to other systems that are out there. And I do have to chuckle because this system is very solid, very easy to follow. You can trade it in either a dual account mode or a single account mode. But when you see at the end of this year how some of these systems, like I read that Jim Cramer's investment club that was started this year, I remember when it came out, I read something today that said, or yesterday, that said they were off 67% for the year. Yikes. I mean, how in the world can someone be off 67% in an environment where you are not effectively allocating your capital? Anyway, pay attention because the MENT Rotational Modeling System is holding up very well. It's actually in a fairly flat model right now. Like I said, it's capable of taking advantage of the moves in the market going forward, and it's staying very, very solid overall. Okay, the real estate update. The Realtor.com update this week only had data for December 3rd. So even though they stated it was data till December 10th, which is about 1 week old. So we need to pay attention here to the rise in the price reduction level. We need to pay attention to the active count listing, which is rising, and the decreasing pricing level. Price level decreases have not yet broken into negative trending, but in my opinion, ladies and gentlemen, we could see that in early next year. Dynamic price modeling is flat. It's actually a little bit weaker last week, but still fairly flat. We have got the market dynamics have changed considerably. This is 1 year ago. We were seeing huge dynamics from market demand. Now demand has weakened back down into this negative 0.36 level. Sorry, negative 36.96 level, almost 37. This continued weakness in the markets is going to push prices into a negative trending mode. It'll probably be by March or April of next year, depending on what the Fed is doing. But understand that from a total U.S. market environment, demand and pricing constraints are much, much weaker. I expect price levels to move into negative trending by, say, February, March of next year. The U.S. price trends indicator, you can see, is briefly positive here. It's hard to see, but let me move it back down here. Just briefly went positive. It's really very flat for the last 4 months here. Price reduction activity is peaking again. You can see almost everything on the market, literally everything on the market is being reduced right now. Active listings are back at the highest point we've seen in the past 3 years. That means that listings and foreclosures are being pushed into the market. Activity, new listing count metrics here. New count is at new highs. You can see new listing count change is up again last week, and new listing share of market is relatively flat. So you can see here we're at 52.80. Considering where we've been, where new listing counts, the blue lines have been negative for years, barely breaching into positives here, positive 10-11%. We're at new listing counts at 52.8. That's telling us that there's a flood of inventory hitting the markets. Reductions are high, active listings are high. Basically, inventory is flooding into the market, and there's not enough buyers. There's just not enough buyers out there to accumulate what's coming on the market. Okay, the heat rank. Heat rank is, again, a little bit high last week, meaning it reverted back higher. That means there was some activity to the upside. You can see the tightness index tighten back up. I expect this to roll over back to the downside. I expect this to roll back to the downside as well on the heat rank. Inventory strength rolled back upward a bit. You can see we've down into strongly negative territory, reverted back higher over the last couple of weeks. And again, the seller desperation index is kind of flattening out. So you can see the heat rank index was up. That means it had a little bit of upward activity in the heat rank. Tightness index is at 30, was up 30.2. That's from these lows down here coming up. So understand that the market is tightening a bit. But this doesn't reflect the new Fed rate change, the new 50 basis point rate increase. Inventory strength is moving tighter, a little bit tighter last week, and seller desperation is weakening, so sellers are not excessively desperate. Now that the rate increases have gone up and inventory is coming and Christmas is here, you need to watch. This is going to start shifting into probably a more desperate downward trend, which could play out in the long run. 2023 could be very difficult for the housing market. Could be very, very difficult, and could be something the Fed has to watch going forward. Right now, I think the strength in the housing market, the lack of real crisis, is allowing the Fed to continue to raise rates, with housing being one of the stronger pricing factor, housing and rent being one of the stronger factors in the economy. Consumers pulling away from the economy, particularly pulling away from the housing market, could change the Fed, could move us into a decidedly different market in 2023 and 2024. So pay attention as we move forward. Remember, I deliver all of this to you, whoops, wrong direction, every week. So you not only get my real estate modeling system, you get the MENT Rotational Modeling System, which is really the key, one of the key advantages here to this, to what I deliver to you. It's simple, it's slow, it's maybe a little boring to some of you, but you cannot argue with these results. These are very strong results, and like I said, watch what happens at the end of the year and watch what happens next year. I mean, take a look at what's happened with the hedge funds in 2021 and 2022, whereas the MENT Rotational Modeling System was killing the markets, and this year has been relatively flat. We'll see what happens at the end of the year. We'll see what happens next year, but remember, this is a very solid basis for you to continue to grow your account. If you have your retirement account or most of your money in a 401k or an IRA, this is really the basis for what you want. And then we go look at trading. Like I mentioned to you, we look at trading as a different level. Trading right now is at 20% of our capital for both allocation levels. We're safely protected. We're not risking the farm. We can still trade. We can still take advantage of trying to gain some opportunity in the triggers that come up, but we are safely protected against risks in the market, and our metals position here is starting to really accumulate. We have been holding this metals position for about 2.5 years. We've seen a big move to the upside after COVID, and then some consolidation. The real reality, ladies and gentlemen, this is just getting started, the metals position, to really start to accumulate for us going forward. Okay, share it with your friends. If you want to give them a Christmas present, teach them about MENT.com and what I do. Show them the real value. Tell them about what I'm doing. And in 2023, I'm going to try to introduce even more incredible technology for you. Okay, guys, we're getting close to Christmas, and we got one more update next week. I will try to do a pre-Christmas update, get some videos done, and then we slide into the end of the year. All right, guys, have a great day. Talk to you later.